Consumer goods firm Tiger Brands posted a 13% increase in full-year earnings, helped by higher sales, but said it anticipates a tough trading environment ahead. Headline earnings per share for the year to the end of September totaled 1.57 cents from 1.39 cents last year. The company declared a final ordinary dividend of 510 cents per share, bringing the total dividend for the year to 791 cents per share.
Tiger Brands got a market cap of 43 billion, price earnings of 14, dividend yield of 3.4. Gerbrand, what hit me was turnover up 5.8% to just over 20 billion. Volumes were actually down 2.3. They really are managing to get some pricing going through, and in fact, not bad price increases at all.
I think they've done very well in a challenging environment. But if you look at the headline earnings per share, I think it went up by about 5.7% as well. So very similar numbers. But as you said, volume down, so prices must have increased, and they seriously had difficult times in some of their operations. We know on the meat packaging or the meat side they had some problems. They declined, I think, by about 18% if you look at operating profit. And on the beverages side as well, with Energade, etc., with a longer cold winter that we had, they had their challenges there as well. So difficult period for them, but I think they hinted to a more difficult period going ahead as well.
Well, I mean, if the CEO talks about tough trading ahead, you know it's really tough out there.
Yeah, certainly, and I think if you look at what the price has done over the last few months, it's actually been extraordinary. I think it's 17% up for the year so far, while the market is down 3 or 4%. So we know this is a share that everybody likes. We know it's a type of a safe haven share, but we also know I don't think the currency depreciation at the moment is too good for them. I think there's probably better places to hide at the moment.
Well, tough trading environments anticipated going forward, Moxima, but that share has just been on the up and up. Looks like it's been doing very well.
Very, very well. Exceptionally well, actually. Nice bull trend. It's maintained its primary bull trend. The only concern is it's formed a steeper uptrend, which is good for profits, but it's also a signal of that this could be the last phase of the bull trend. Bit of resistance at 286.35. When it did peak there, the RSI formed a lower top, which means there's a bit of divergence, which is also signaling an impending reversal. We would actually feel that the RSI support trend line could curb further downside, but if that gives in, then that 21,200 level could be bridged, which could then cause it to at least the sell-off back to this major support trend line. So this would just be a pullback within the bull trend. So at 121 level, rather the 212 level would be the one we should watch out for. But the biggest indicator would be that RSI support trend line.
In essence, if it gets back to that sort of 195, 198 level, which is on that long support line, we're looking at really, really juicy buying opportunities, assuming that holds.
Yes, really, because this, I mean, we still expect it to remain bullish. That would give that you could just load onto your stocks from that point at that point.
Well, given the fact that Tiger Brands account for 15% of goods sold to every major retailer in the country, it seems to me that even with Walmart's procurement strategy, Tiger doesn't really have anything to be fearful of. Your comment, Gerbrand?
Yeah, I don't think that would damage them too much. If you look at the latest survey that was done, I think it was released yesterday or a while back, I'm not sure. Koo is actually #1 brand in South Africa. That's one of their brands now. It's overtaken Coca-Cola. So for a company like Massmart to take some of these well-branded names from Tiger Brands off their shelves is certainly not going to benefit the number of people going into their store, etc. So certainly they would have their tie-ups already with Massmart, etc. And I don't think that would be a problem for them going forward. Although I think if you're looking at price-sensitive consumers, you might get some of them that purchasing a bit lower on prices, etc., and they might get some substitute products in. That might be a little bit of concern, but I think they have identified that maybe as a threat going forward. And if you look at their strategy is at the moment only 10% offshore holdings or revenue and profits, but they're certainly throwing a lot of money in there at the moment. We know that they did about 2.1 billion rand of acquisitions this year in 4 major countries, in 4 good companies, etc. So it's certainly something that they're looking at expanding elsewhere as well. We know they had a great time in South Africa over the last 20, 30 years, and then it's probably come to an end, the excessive growth that they had. They got better competitors than they used to have. We're talking of the likes of AVI Pioneer Foods, etc., in some of their divisions. So it's going to be a bit of a cutthroat business going forward, and I think they've warned about it.
And hence the move into Africa. And a couple of points there. Firstly, I mean, Walmart/Massmart can almost help them move into there. They're doing very strongly there already in that move into Africa. We mentioned it on Ilova. The currencies are chaos. We saw Wilderness, which is probably a stock you don't look at, but I mean, their currencies, which is killing them left, right and centre. And the movements across Africa, it's the same challenge MTN has. A country does great in its base currency, bring it back to rands, it's suddenly not quite so exciting.
Yeah, I'm not a huge fan of currency hedging, etc. But I think in Africa, if you want to do business in Africa, that might be a sound policy going forward for some of these companies. Because with all the results that we've gained so far, it's certainly something that is a problem, especially in Nigeria and some of these other countries. We know what happened to their currencies over the past year or so. So it is a very difficult and a different dynamic to the business. But certainly if you can manage that well, there's a lot of growth opportunities in Africa. Well, I think that's the main concern.
Let's touch on the company's dividend policy now. Obviously paying out 7.95 for 2011. Last year it was 7.46. The year before 7.04. Interesting to note that with all the acquisitions that have been made, 2.1 billion rands in this year, the company still being able to maintain that. Relative to someone like AVI, how would you measure up Tiger Brand's dividend policy and payout?
Yeah, look, I think long-term history suggests that they got a great dividend payout history, etc. At the current multiples, it's just getting a bit lofty. You're getting a 3.5 dividend yield. I would like to buy Tiger when you got a 4.5% dividend yield, which they had about 2-3 months back. At below 190, it looks a bit more juicy on that side. Pioneer Foods is still on a massive growth strategy, so you're not receiving great dividends there, if any. And AVI, I think, got their shop together very well. I think Tiger Brands and AVI's dividend yield at the moment is close to the same. But if you look at the positive growth that AVI is delivering at the moment, you're probably going to, from next year, going to see a higher dividend yield in your AVI shares. But all depends what happens with the economy itself, the consumer, etc. Because if they're going to buy it down, you're going to see Tiger Brands benefiting, and you're going to see AVI losing some customers again. So it's very difficult. But right now, you're probably looking at AVI, the better dividend yield for the next year or two. But not a bad dividend yield.
Not
you
bad.
would just like
better than Massmart. I want to bring back, I mean, we mentioned Ilova's operating margin. They're still operating margin at just under 15%. Their target, they call it operating income margin, is 15%. That to me seems quite chunky for fast-moving consumer goods. I really thought it would have been a lot more wafer thin.
Yeah, look, and I think if you compare that to offshore companies, that is a bit high, and that's why I said earlier that I think the consumer is paying a bit too much in South Africa for its goods that they purchase every day. If you look at a company like Pick n Pay and all of the other retailers which are sitting on margins of 4%, 5%, 6%, and 7%.
Absolutely.
So it's still a very healthy dividend yield, profit margin. So it would be interesting to see if they can maintain it going forward, because they got a lot of input cost pressures going forward, especially on the milling side, etc., what happened to the currency. And that's why one of the things that they probably want of a tough year going forward.
Well, you're mentioning that the South African consumers paying too much for the goods that they're purchasing at the retailers. Are investors paying too much for Tiger Brands at current levels?
I think so. Look, I think it's lukewarm. It's a nice company to own in difficult times. Don't make a mistake. It is a defensive counter, and it will pay your dividends next year, etc. But the growth rate that they're looking at the moment over the past year and going forward is a bit too slow for the multiple that you're paying of 14 or 15. And I think in 2 years' time, the PE multiple is at 13 still. So I think some of the competitors do look a bit better on price at the moment. And on dividend yields, there's probably better buys dividend yields as well. We still hold some of the company. We lighten up a bit. We'll see if we lighten up more. But it's certainly something that you want long-term wise in your portfolio. But current multiples, it's a bit lofty.
Bit lofty for Gerbrand. Moxima, hot or not for you, Tiger Brands?
In the short to medium term, I'd rather say lukewarm, but with potential hotness in the long term. So I would, in the long term, it would be a hot stock, but because of that divergence on its RSI, which is warning us of an impending pullback, we would say lukewarm for this.
Lukewarm, but you have chosen something very hot as your stock pick, DRD Gold.
Right.
Tell us why.
Well, DRD has really been a dog stock over the years, and what it's done is it's starting to form this bottoming up pattern. Kept it at least kept support at 280. Now you would think it's a bit too late to enter, which it probably is, because the best time to have gotten in was at 4.10. But we do see more potential upside because it's completed that consolidation phase, is now going to commence the ascending phase with potential gains to the 9.55 level. So we would really, this is more of a buy and hold. You wouldn't really want to be too active with it. And we would suggest at least to pick up the stock at every pullback. Like I said, the potential upside is at 9.55. So RSI keeps lingering on overbought territory. If it does linger on overbought territory for too long, that could also be a bit of a caution signal. But at this point, it's looking pretty healthy, and it's a very attractive stock.
Hot DRD Gold. Gerbrand, what's your stock pick for today?
I'm going to have Met Air today. It's about 2.5 billion rand company. Trades about 17 rand at the moment. PE multiple of about 7.5. Sitting with a dividend yield of about 4%. A very strong balance sheet, no gearing in there. They got 300 million on balance sheet cash, and then they also got about 700 million rand worth of property, which they only value at 300 million, but it's lots and lots of industrial space. If you value it at market value or at half of market value, you get close to R1 billion in balance sheet, which is looking for us like a very good, healthy stock for the future. And they're in the automobiles and parts game. So it's a difficult space. It's a bit cyclical, but I think if you've got a strong balance sheet like that and you've got a P multiple of 7 and dividend yield of 4, I'm willing to pay that.